Question 1. What is the primary advantage of forming a captive insurance company? A. Captive insurance companies provide lower premium rates than traditional insurers. B. Captive insurance companies are exempt from all state and federal regulations. C. Captive insurance allows for better risk management and cost control for the parent company. D. Captive insurance companies only insure property and casualty risks. Answer: C. Captive insurance allows for better risk management and cost control for the parent company. Explanation: the primary advantage of forming a captive insurance company is the ability to better manage and control risks and associated costs for the parent company. By insuring its own risks, a business can retain control over the underwriting process, reduce insurance premiums, and tailor coverage to its specific needs. Captives also allow for more effective risk management and can result in long-term savings through reduced reliance on traditional commercial insurance markets. Option A. While captive insurance companies may offer low premiums in certain cases, the primary benefit is risk control, not necessarily low premiums. Option B. Captives are subject to state and federal regulations, although they may benefit from regulatory flexibility and more tailored insurance solutions. Option D. Captives can insure various types of risks including property, casualty, workers' compensation, and liability, not just property and casualty. Question 2. Which of the following is the key requirement for the formation of a captive insurance company in Mississippi? A. A captive insurance company must maintain a minimum surplus of $1 million at all times. B. Captive insurance companies in Mississippi must operate as a group or association structure. C. The parent company must conduct a feasibility study before establishing a captive. D. Captive insurance companies are required to hold 100% of their reserves in cash. Answer: C. The parent company must conduct a feasibility study before establishing a captive. Explanation: in Mississippi, a feasibility study is a key step in the process of forming a captive insurance company. The study helps determine the financial viability of the captive and assess the risks that the parent company intends to insure. It also evaluates the costs, structure, and potential benefits of establishing the captive, which is crucial for compliance with state regulations. Option A. While captives must meet certain capital and surplus requirements, the $1 million figure is not a standardized requirement. Surplus requirements are determined based on the size and structure of the captive. Option B. Captive insurance companies in Mississippi can be formed in various structures, including single-parent captives, renter captives, and group captives, depending on the business needs. Option D. Captives have flexibility in how they manage their reserves. Holding 100% of reserves in cash is not a mandatory requirement. Question 3. Scenario-based question. Mr. Thompson is the CEO of a large manufacturing company and is considering forming a captive insurance company in Mississippi. He is unsure about whether to structure it as a single-parent captive or a group captive. What should Mr. Thompson consider when making this decision? That single-parent captives are only suitable for large multinational companies, while group captives are for small businesses only. B. A group captive may allow Mr. Thompson to share the risk and costs with other companies, whereas a single-parent captive will provide full control over the insurance program. C. A group captive offers no flexibility in coverage options, while a single-parent captive allows for better control and customization of policies. D. Both structures offer identical benefits and costs, so Mr. Thompson should base his decision on which one is more popular in the industry. Answer: B. A group captive may allow Mr. Thompson to share the risk and costs with other companies, whereas a single-parent captive will provide full control over the insurance program. Explanation: when deciding between a single-parent and a group captive, Mr. Thompson should consider his company's desire for control versus the potential for sharing risk and reducing costs. A single-parent captive provides full control over the captive's operations, including risk management, coverage options, and financial decisions, which is ideal for companies that want to tailor insurance to their specific needs. In contrast, a group captive allows multiple companies to pool their resources and share risk, making it a more cost-effective option for companies that do not want to take on the entire risk alone. Group captives also provide opportunities for smaller businesses to access the benefits of captive insurance. Option A. The size of the company does not exclusively dictate the structure choice. While larger companies might prefer single-parent captives, group captives can also serve large companies with specific needs. Option C. A group captive offers flexibility in coverage, but it involves sharing decision-making with other members. Single-parent captives typically allow for more customized policies, but they do not preclude the ability to offer flexible coverage. Option D, the decision should not be based solely on industry popularity, but rather on the specific risk management needs and business goals of Mr. Thompson's company. Question 4. What is a key regulatory requirement for a captive insurance company domiciled in Mississippi? A. Captive insurance companies in Mississippi must file annual reports with the Mississippi Department of Insurance. B. Captive insurance companies are exempt from maintaining reserves as long as they are sufficiently capitalized. C. Mississippi captives do not need to comply with federal tax laws if they are formed under state law. D. Captive insurance companies in Mississippi must obtain approval from the Federal Insurance Regulatory Authority before they can issue policies. Correct answer. A. Captive insurance companies in Mississippi must file annual reports with the Mississippi Department of Insurance. Explanation. Captive insurance companies domiciled in Mississippi are required to file annual reports with the Mississippi Department of Insurance. DOI. This includes submitting financial statements, actuarial opinions, and other documentation to ensure regulatory compliance. Annual filings allow the DOI to monitor the financial health and solvency of captives operating in the state. Option B. Captives are still required to maintain sufficient reserves even if they are capitalized. Solvency regulations are enforced to protect policyholders and maintain financial stability. Option C. Captives formed under Mississippi law must comply with federal tax regulations, including tax filings, with the IRS. Option D. There is no federal insurance regulatory authority approval required for Mississippi domiciled captives. State-level regulation is sufficient for approval. Question 5. Which of the following best describes the tax advantages for a captive insurance company under the Mississippi Tax Code? A. Captives in Mississippi are subject to a flat 5% state insurance premium tax. B. Captives formed in Mississippi are eligible for a 100% tax exemption on all insurance premiums. C. Mississippi offers tax credits for captives that reinsure risks outside of the state. D. Mississippi allows captives to elect a special tax treatment under Section 831B of the Internal Revenue Code. Answer. D. Mississippi allows captives to elect a special tax treatment under Section 831B of the Internal Revenue Code. Explanation. Mississippi offers captives the ability to elect special tax treatment under Section 831B of the Internal Revenue Code, which provides favorable tax treatment to captives with annual premiums of $2.3 million or less. This election allows captives to exclude underwriting income from federal taxation, offering significant tax savings for smaller captives. However, the election must be made in compliance with federal requirements. Option A. While Mississippi does have an insurance premium tax, it is typically based on the amount of premium written and may vary depending on the structure of the captive, not a flat 5%. Option B. There are no 100% tax exemptions for captives in Mississippi. While captives benefit from favorable tax treatment, they are still subject to certain state and federal taxes. Option C. While captives can reinsure risks outside of Mississippi, there is no specific tax credit for doing so under state law. Question 6. What is the primary function of the Mississippi Captive Insurance Association, McKeer? A. To provide insurance coverage to all captive insurance companies domiciled in Mississippi. B. To advocate for the captive insurance industry and provide networking opportunities. C. To regulate captive insurance companies in Mississippi. D. To provide actuarial services and financial audits to captives. Answer. B. To advocate for the captive insurance industry and provide networking opportunities. Explanation. The Mississippi Captive Insurance Association, McKeer, serves as an industry trade group that advocates for the interests of the captive insurance sector in Mississippi. It helps to promote the state as a domicile for captives and provides educational and networking opportunities for captives, regulators, and service providers. It does not directly regulate captives, but it plays an important role in fostering the growth of the industry in the state. Option A. The MCIA does not provide direct insurance coverage. It is focused on advocacy and industry promotion. Option C. The regulation of captives is the responsibility of the Mississippi Department of Insurance, not the MCIA. Option D. While the MCIA may support educational efforts, actuarial services and audits are provided by independent firms, not the association itself. Question 7. Which of the following is a permissible investment strategy for a captive insurance company? A. A captive is prohibited from investing in any foreign markets or international securities. B. Captives are allowed to invest in stocks and bonds but must avoid real estate investments. C. Captives may engage in asset liability matching to ensure their investments align with their liabilities. D. Captives are required to invest 100% of their reserves in short-term government bonds. Answer: C. Captives may engage in asset liability matching to ensure their investments align with their liabilities. Explanation: one permissible investment strategy for captives is asset liability matching, which involves aligning the timing and risk profile of investments with the expected claims and liabilities. This strategy ensures that a captive's investments are structured to meet its future obligations. Option A: captives can invest in foreign markets and international securities, provided they comply with relevant regulations and guidelines. Option B: captives are not limited to investing only in stocks and bonds, they can also invest in real estate and other assets, subject to regulatory restrictions. Option D: captives are not required to invest 100% of their reserves in government bonds. They have flexibility in investment choices based on their financial goals and regulatory requirements. Question 8. Which of the following best describes the role of reinsurance for a captive insurance company? A. Reinsurance is typically unnecessary for captives as they fully retain all risk. B. Reinsurance is used to transfer risk to third-party insurers to protect the captive's financial stability. C. Reinsurance for captives is only required when they exceed $10 million in annual premiums. D. Captives cannot use reinsurance if they elect Section 831(b) tax treatment. Answer: B. Reinsurance is used to transfer risk to third-party insurers to protect the captive's financial stability. Explanation: reinsurance is a key risk management tool used by captives to transfer part of the risk to third-party insurers. This helps protect the financial stability of the captive by reducing its exposure to large losses. Captives may enter into various reinsurance agreements, such as quota share or excessive loss, to manage their risk and limit potential liabilities. Option A: while captives often retain substantial risk, many also use reinsurance to manage volatility and protect their financial position. Option C: reinsurance is not tied to a specific premium threshold. Captives of any size may use reinsurance based on their risk management strategy. Option D: captives that elect Section 831(b) tax treatment can still use reinsurance as part of their overall risk management strategy. Question 9. Mr. Harris is the CFO of a medium-sized manufacturing company and is considering whether to use a captive insurance company to manage his company's workers' compensation risks. What factors should Mr. Harris prioritize when making this decision? A. The potential for a significant reduction in insurance premiums compared to the commercial market. B. The ability to avoid all state and federal tax obligations. C. The ability to insure only property risks, as captives cannot cover liability or workers' compensation risks. D. The fact that captive insurance companies do not need to maintain solvency requirements if they are privately owned. Answer A. The potential for a significant reduction in insurance premiums compared to the commercial market. Explanation: one of the primary reasons companies establish captive insurance is to reduce insurance costs. By forming a captive, companies can often save on premiums compared to what they would pay in the commercial market, particularly for specialized risks like workers' compensation. Additionally, captives allow companies to retain more control over their claims experience and underwriting processes. Option B: while captives provide tax advantages, they are still subject to both state and federal tax obligations, especially when premiums exceed the threshold for tax benefits. Option C: captives can cover a wide range of risks, including workers' compensation, property liability, and more. Option D: captives are subject to solvency requirements, regardless of ownership structure, to ensure they can meet their obligations to policyholders. Question 10. Which of the following is a primary advantage of forming a captive insurance company in Mississippi? A. Captives are exempt from all state insurance regulations. B. Captives can self-insure for all types of business risks, including workers' compensation, property, and liability. C. Captives are required to maintain high levels of risk retention without reinsurance options. D. Captives in Mississippi do not have to comply with federal tax laws. Answer: B. Captives can self-insure for all types of business risks, including workers' compensation, property, and liability. Explanation: a major advantage of forming a captive insurance company in Mississippi is the ability to self-insure for various business risks, including workers' compensation, property, and liability risks. This flexibility helps businesses better manage and reduce insurance costs by tailoring their coverage to their specific needs. Option A: captives are still subject to state regulations, though they are typically given more flexibility compared to traditional insurance companies. Option C, captives can use reinsurance to manage risk and they are not required to maintain high retention without it. Option D, captives are subject to federal tax laws, including tax treatment under Section 831B, and must comply with relevant reporting and tax obligations. Question 11. Which of the following is an example of a risk that might be better suited for self-insurance through a captive insurance company? A. Large-scale catastrophic natural disasters. B. Small, frequent operational losses. C. Risks that require guaranteed coverage from a third-party insurer. D. Risks covered by federal insurance programs. Answer B. Small, frequent operational losses. Explanation: self-insurance through a captive insurance company is often well suited for covering small, frequent operational losses. These types of risks may not justify the cost of traditional insurance, but they can be effectively managed through a captive, which allows the company to retain more control over claims and expenses. Option A. Large catastrophic risks typically require reinsurance or traditional commercial insurance, as captives may not have the resources to handle large-scale losses. Option C. Captives are designed to self-insure risks, not to guarantee coverage from third-party insurers. Option D. Risks covered by federal insurance programs, such as certain flood or terrorism risks, are typically not insurable through a captive. Question 12. What is the minimum capital requirement for forming a captive insurance company in Mississippi? A. $100,000. B. $500,000. C. $1 million. D. There is no specific minimum capital requirement. Answer B. $500,000. Explanation: in Mississippi, a captive insurance company is generally required to have a minimum capitalization of $500,000. This ensures that the captive has sufficient financial resources to meet its obligations and maintain regulatory solvency. Option A. The capital requirement is higher than $100,000. Option C. The minimum capital requirement is not as high as $1 million. Option D. A minimum capital requirement exists for forming a captive in Mississippi. Question 13. Which of the following would be a likely reason for a company to form a captive insurance company? A. To eliminate all insurance premiums. B. To retain control over its risk management and claim handling. C. To avoid paying taxes on all income. D. To avoid having to file annual reports with the state. Answer B. To retain control over its risk management and claim handling. Explanation: one of the main reasons companies form a captive insurance company is to retain control over their risk management processes and claims handling. This allows businesses to customize coverage, reduce reliance on third-party insurers, and potentially save on premiums. Option A. While captives can reduce premiums, they do not eliminate all insurance costs, as captives still need to cover risks. Option C. Captives still need to comply with tax obligations and cannot avoid taxes on all income. Option D. Captives are still subject to state regulatory requirements, including filing annual reports. Question 14. What is the primary role of the Mississippi Department of Insurance, DOI, in relation to captive insurance companies? A. To act as a third-party reinsurance provider for captives. B. To regulate and oversee the formation and operation of captive insurance companies. C. To market captives to prospective clients. D. To determine the premium rates for captives. Answer B. To regulate and oversee the formation and operation of captive insurance companies. Explanation: the Mississippi Department of Insurance, DOI, is responsible for regulating and overseeing the formation and operation of captive insurance companies within the state. The DOI ensures that captives maintain financial solvency, comply with state laws, and meet regulatory requirements. Option A. The DOI does not act as a reinsurance provider. Instead, it regulates the industry. Option C. The DOI does not market captives, as this is typically the role of industry professionals or associations. Option D. While the DOI oversees captives, it does not directly set premium rates for individual companies. Question 15. A company with a captive insurance company domiciled in Mississippi wants to reinsure a portion of its risk. Which of the following is true regarding the reinsurance process? A. The captive must reinsure all of its risks with third-party insurers. B. Reinsurance agreements must be approved by the Mississippi Department of Insurance. C. Reinsurance is prohibited for captives in Mississippi. D. The captive may only reinsure risks with other captives domiciled in Mississippi. Answer B. Reinsurance agreements must be approved by the Mississippi Department of Insurance. Explanation: reinsurance agreements entered into by captives in Mississippi must be approved by the Mississippi Department of Insurance. DOI to ensure that the agreements comply with state laws and meet the regulatory requirements. This is part of the overall regulatory framework designed to protect the financial solvency of captives. Option A. Captives are not required to reinsure all their risks. They may choose to retain a portion of their risks and only reinsure others. Option C. Reinsurance is allowed for captives and is commonly used as a risk management tool. Option D. Captives may reinsure risks with insurers both inside and outside of Mississippi, not just other captives in the state. Question 16. Which of the following types of insurance risks would a captive insurance company most likely cover? A. Public liability insurance. B. Health insurance for employees. C. Environmental pollution liability. D. All of the above. Answer: D. All of the above. Explanation: captive insurance companies can cover a wide range of risks including public liability insurance, health insurance for employees, and environmental pollution liability. Captives are often used to self-insure risks that are difficult or expensive to insure in the commercial market, giving businesses more control over their coverage. Option A. Public liability insurance can be covered by a captive insurance company. Option B. Employee health insurance can also be covered through a captive. Option C. Environmental pollution liability is another type of risk that captives can insure. Question 17. What is the purpose of a captive insurance company's actuarial opinion? A. To determine the market rates for premiums. B. To assess the solvency of the captive and the adequacy of its reserves. C. To evaluate the performance of third-party insurers. D. To determine the appropriate reinsurance structure for the captive. Answer: B. To assess the solvency of the captive and the adequacy of its reserves. Explanation: the actuarial opinion is an important document that assesses the solvency of the captive insurance company and evaluates whether the captive has adequate reserves to meet its future obligations. This opinion is required to ensure the financial health of the captive and to demonstrate that it is able to cover potential claims. Option A. The actuarial opinion does not set premium rates. Premium rates are typically determined based on risk assessments and underwriting. Option C. The actuarial opinion is focused on the captive's own solvency, not on third-party insurers. Option D. While an actuarial opinion may consider reinsurance needs, its primary purpose is to assess the captive's financial health. Question 18. How does forming a captive insurance company help a business manage its overall risk exposure? A. By allowing the business to eliminate all of its insurance premiums. B. By increasing the business's ability to take on additional risk without financial consequences. C. By providing more control over insurance coverage, risk management, and claims handling. D. By guaranteeing that the business will never face any catastrophic losses. Answer: C. By providing more control over insurance coverage, risk management, and claims handling. Explanation: forming a captive insurance company allows a business to have more control over its insurance coverage, risk management strategies, and claims handling. This can lead to cost savings, greater flexibility in tailoring coverage to the company's unique risks, and a more efficient management of claims. Option A. Captives reduce insurance premiums, but they do not eliminate them entirely, as the business must still cover some of its risks. Option B. While captives allow businesses to retain more risk, they do not eliminate that. Question 19. Which of the following would most likely trigger the creation of a captive insurance company in Mississippi? A. The company has a large number of standard insurance policies it needs to renew. B. The company faces high and unpredictable insurance premiums in the commercial market. C. The company wants to diversify its investment portfolio by entering the reinsurance market. D. The company's existing insurance providers are unable to cover its foreign operations. Answer: B. The company faces high and unpredictable insurance premiums in the commercial market. Explanation: companies often form captive insurance companies when they face high and unpredictable premiums in the traditional insurance market. A captive allows them to self-insure and potentially lower their overall insurance costs by managing their own risks. Option A. The creation of a captive is not typically triggered by the need to renew standard insurance policies. Option C. Although some captives may use reinsurance, their primary purpose is not to diversify investment portfolios. Option D. Captives may cover foreign operations, but their creation is more commonly driven by cost management concerns. Question 20. What is one key regulatory advantage of forming a captive insurance company in Mississippi? A. No oversight from state regulators is required. B. The company is exempt from solvency regulations. C. The company may receive more flexible tax treatment. D. The company is guaranteed premium rates below market value. Answer: C. The company may receive more flexible tax treatment. Explanation: captive insurance companies may benefit from flexible tax treatment under certain conditions, including the potential to deduct premiums as a business expense and structure the company's operations for tax efficiency. This can provide significant financial advantages. Option A: captives in Mississippi are still subject to oversight by the state's Department of Insurance. Option B: captives are subject to solvency regulations to ensure financial stability. Option D: while captives may reduce premiums, they are not guaranteed rates below market value. Question 21. In Mississippi, which of the following is a common type of captive insurance company? A. Protected cell company. B. Mutual insurance company. C. Reinsurance pool. D. Direct writing insurer. Answer: a protected cell company. Explanation: a protected cell company (PCC) is a common structure for captives in Mississippi. It allows a parent company to form a captive with segregated cells for different risks, ensuring that each cell's liabilities are protected from the others. Option B: a mutual insurance company is a different structure from a captive. Option C: a reinsurance pool is a separate concept from a captive, although captives may engage in reinsurance. Option D: a direct writing insurer refers to a company that sells insurance directly, which is not typically a form of captive. Question 22. Which of the following is a required feature of a captive insurance company domiciled in Mississippi? A. The captive must be managed by a third-party insurer. B. The captive must retain at least 30% of its risk. C. The captive must file a comprehensive business plan with the Mississippi Department of Insurance. D. The captive must insure only the parent company's risks. Answer: C. The captive must file a comprehensive business plan with the Mississippi Department of Insurance. Explanation: captive insurance companies in Mississippi are required to submit a comprehensive business plan to the Mississippi Department of Insurance as part of the approval process. This plan outlines the captive's operations, risks, financial projections, and risk management strategies. Option A: captives can be managed by the parent company, not necessarily by a third-party insurer. Option B: there is no fixed requirement to retain a specific percentage of risk, like 30%. It depends on the captive structure and risk management decisions. Option D: captives can insure a variety of risks, including risks from other entities in the group, not just the parent company. Question 23. What is a key reason why captives often purchase reinsurance? A. To reduce administrative costs of claims handling. B. To increase the amount of capital available for investment. C. To manage risk and protect against large losses. D. To gain access to government-funded programs. Answer: C. To manage risk and protect against large losses. Explanation: captives often purchase reinsurance to manage large, catastrophic risks and protect against potential losses that exceed their financial capacity. Reinsurance helps captives share risk with other insurers, which is especially important for large or volatile risks. Option A: reinsurance does not primarily reduce administrative costs, which are usually managed in-house by captives. Option B: the purpose of reinsurance is not to increase capital for investment, but to manage risk exposure. Option D: captives do not typically gain access to government-funded programs through reinsurance. Question 24. Which of the following would most likely be included in a captive's risk retention plan? A. The types of risks the captive will retain and the amount of loss it can handle. B. The market share the captive intends to achieve in the insurance market. C. The captive's investment strategy for assets held in reserves. D. The amount of premium the captive intends to charge its clients. Answer A. The types of risks the captive will retain and the amount of loss it can handle. Explanation: a risk retention plan outlines the specific types of risks the captive intends to retain and the amount of loss it can manage effectively. This plan is essential for determining the captive's financial strategy and risk exposure. Option B: market share is not typically a consideration in a captive's retention plan. Option C: while the investment strategy is important, it is usually covered in a separate financial plan, not the risk retention plan. Option D: the premium charged is part of the pricing and underwriting strategy, not directly related to the retention plan. Question 25. Which of the following is typically a benefit of forming a captive insurance company in Mississippi? A. Reduced regulatory requirements compared to traditional insurance companies. B. Guaranteed access to international reinsurance markets. C. Lower tax rates on premiums paid to reinsurers. D. Ability to insure a wide range of risks with tailored coverage. Answer: D. Ability to insure a wide range of risks with tailored coverage. Explanation: A major benefit of forming a captive insurance company is the ability to insure a wide range of risks and create tailored coverage that fits the specific needs of the parent company. Captives can be customized to cover unique risks that are often difficult or expensive to insure through traditional markets. Option A. While captives may enjoy certain regulatory flexibility, they are still subject to regulations by the state's Department of Insurance. Option B. Captives may gain access to international reinsurance markets, but it is not guaranteed. Option C. The tax treatment of premiums is not specifically reduced for reinsurers, and captives are still subject to tax regulations. Question 26. A company is considering forming a captive insurance company in Mississippi but is concerned about potential liquidity risks. What is the best way to manage this concern? A. Set up a dedicated reinsurance agreement with a third-party insurer. B. Purchase excess liability insurance for the captive. C. Ensure the captive maintains a sufficient reserve fund and considers liquidity needs in its business plan. D. Offer dividends to the parent company to reduce the captive's capital. Answer. C. Ensure the captive maintains a sufficient reserve fund and considers liquidity needs in its business plan. Explanation. To manage liquidity risks, captives must maintain an adequate reserve fund to ensure they have the necessary cash flow to cover claims and expenses. This should be included in the business plan to ensure that liquidity risks are effectively managed. Option A. Reinsurance agreements help mitigate large risks but do not directly address liquidity concerns. Option B. Excess liability insurance could help cover large claims but does not directly address liquidity risks. Option D. Offering dividends can reduce capital and worsen liquidity concerns if not managed carefully. Question 27. Which of the following is a common reason for a business to use a captive insurance company for employee benefits? A. To provide long-term care insurance to employees. B. To offer health insurance at a reduced cost. C. To guarantee life insurance coverage for all employees. D. To ensure workers' compensation claims are handled externally. Answer. B. To offer health insurance at a reduced cost. Explanation. A common use of captives is to offer health insurance to employees, especially when traditional premiums are too high. By self-insuring through a captive, businesses can potentially lower costs while tailoring coverage to the specific needs of their workforce. Option A. Long-term care insurance is not typically a focus of captives. Option C. Captives can offer health insurance but may not guarantee life insurance coverage for all employees. Option D. Workers' compensation is commonly insured through a captive, but the goal is to handle it internally, not externally. Question 28. What is the role of a captive manager? A. To act as the sole provider of reinsurance for the captive. B. To oversee the day-to-day operations, claims handling, and regulatory compliance of the captive. C. To determine the premium rates for policies written by the captive. D. To handle all investments for the parent company's assets. Answer. B. To oversee the day-to-day operations, claims handling, and regulatory compliance of the captive. Explanation. A captive manager plays a critical role in the administration of the captive insurance company. They manage the day-to-day operations, ensure claims handling is efficient, and help the captive comply with regulatory requirements set by the state insurance department. This enables the captive to function smoothly and meet legal and operational standards. Option A. While a captive may purchase reinsurance, the captive manager is not typically the sole provider of reinsurance. Option C. Premium rates are typically determined by the captive's underwriting process, which may be overseen by the captive manager but not solely determined by them. Option D. Captive managers do not generally manage the parent company's assets. Their focus is on the captive's operations. Question 29. Which of the following is one of the potential challenges of managing a captive insurance company? A. Ensuring that premiums remain the same each year. B. Dealing with the administrative complexity and regulatory requirements. C. Increasing the company's profits by lowering claims. D. Guaranteeing a fixed return on investments. Answer. B. Dealing with the administrative complexity and regulatory requirements. Explanation. One of the key challenges of managing a captive insurance company is handling the administrative complexity and ensuring the company complies with regulatory requirements. This involves meeting legal and financial standards, filing regular reports, and maintaining appropriate capital levels. Option A. Premiums can fluctuate based on risk exposure, and captives generally have flexibility in setting them. Option C. While managing claims is important, it is not about increasing profits by lowering claims. The goal is to handle claims efficiently. Option D. A fixed return on investments is not guaranteed in a captive structure. Returns depend on the market and the investment strategy. Question 30. Which type of insurance risk is most suitable for a captive insurance company? A. Low frequency, high severity risks. B. High frequency, low severity risks. C. Standard personal auto insurance risks. D. Short-term life insurance risks. Answer A. Low frequency, high severity risks. Explanation. Captives are well suited to cover low frequency, high severity risks, which might be too costly or difficult to insure through the traditional market. By using a captive, companies can better manage the volatility and financial exposure associated with these types of risks, such as catastrophic losses or specialized coverage needs. Option B. High frequency, low severity risks are typically handled through traditional insurance products. Option C. Personal auto insurance is not typically a risk covered by captives. Option D. Life insurance risks are generally handled by traditional life insurance companies, not captives.